All right. One of the things we try to teach here on the program is it's simple. It's Navy SEAL logic. That's where I got this from. It says, you're planning a mission. You're planning a mission, and obviously you put together a plan, and you've got a map of the terrain that you're moving into. What happens? What happens when you get on the ground and the terrain is different? What if the map's wrong? What do? Do you stick with the map? Or do you deal with the terrain? Well, again, the old saying, it is what it is. The terrain is what it is. This is what we deal with here on the program. And we're going to get into this today. We're going to talk about the Federal Reserve, the perpetually wrong Federal Reserve. And this is going back decades. And again, we've been consistent here on the program and following the Fed and yelling and screaming about the pricing of money and how it's been mispriced, where the Fed could have stepped in on many occasions. Got a few phone calls and from the higher ups, I guess, whether it be at the White House at that point in time or banks saying, no, lay off. We'll get into that. We also got to get into the mortgage-backed security anxiety that everyone's talking about. A lot of people are confused about what this means. We're going to go over again. Okay, we're going to explain obviously what it means if it's ready to sell or hold to maturity. And those two things are very, very important. And we're going to talk about dumb banking regulations. And again, we made fun of Dodd-Frank when it was passed. We made fun of Sarbanes-Oxley when it passed. And again, I actually went back and I looked at some columns that I wrote back during the crisis, 2008, 2009. And many of the things that I was saying at that point in time, it's amazing, are still true today due to absolutely stupid regulations. Stuff that, quite frankly, is holding economic growth here in this country back. But let's start about the bank deposits here. We touched on this. There is a conversation being had at whether or not the FDIC could, if they wanted to, basically circumnavigating Congress, basically saying, hey, all deposits are good. All deposits are good. We're going to take care of everything. Now, let's take a couple steps back here. You got certain people out there saying, wait a second. You can't do that. What, we got $18 trillion in deposits. How is that possible? You got to put an $18 trillion fund? No, you're not. You don't need an $18 trillion fund. You guarantee all the deposits, kind of basically, in essence, it would prevent runs on banks, with that being said. But there's other issues, okay? And I've talked about moral hazard that we've got to get into as well, and how banks conduct themselves. However, I'm dealing with the terrain here, people. I am. There's realities out there. There's realities out there. If you are a business owner, you don't want to have, 10 different accounts. If you've got a mid-sized business to do payroll, where money has to come from various different banks that goes to ADP or whoever's handling your payroll, that's an absolute mess. But again, it's not a difficult problem to fix. We could talk about having a higher level of insurance. Business owners, I think, wouldn't have any problem paying a little bit extra to protect their payrolls. Obviously, make it a deduction, whatever it may be, to protect that money so those issues do not happen. As far as deposits above $250,000, okay. Again, we talked about Silicon Valley Bank, and 90% of the deposits were above that amount. Again, Silicon Valley Bank is telling its customers, hey, you want to do business with us. You want to have access to our lending facilities, our credit facilities, and the connections that we have and what we provide you. All of your money needs to be here. Again, should these people have thought that this might be a little bit risky? Yeah, I guess you're right. I guess you're right. But when, we're told as a society by the powers that be that, we've got, I got this big consumer protection board. You've got all of these new regulations that have come down. You've got Dodd-Frank. You've got the Fed. Banking system is perfectly safe. You don't have to worry about anything. And that's what people were told. That's what people were told, and they believed it. They believed it. Again, I talked about this false sense of security that regulators give to American people. Now, again, another thing that we need to discuss when it comes to deposits, and something new has to be done. There's no doubt about it, whether you're going to raise it, whether you're going to offer people the opportunity to purchase, a higher limit when it comes to insurance. I don't know. Something needs to be done because, again, we all understand that bank runs can happen with bad information. And I mentioned this on the show a week or two ago. I talked about Chuck Schumer and Indy Mac Bank back in 2008 and the run that was caused there. It doesn't take much. And in today's day and age, with the social media and the type of technology that we have, it's not difficult to create a fake story and get people scared about a certain bank and to cause a run. Again, to me, we're also looking at a situation where this is national security concern. I'm being honest here. This to me is more frightening than, I'll be honest with you, than ISIS. One of the commanders saying, yes, ISIS, Afghanistan's retrenching. They're going to attack America in the next 6 months. Oh, give me a break. ISIS is not I'm just enough. Okay. This to me, it's going to do a hell of a lot more damage. In the same sense, in the past, we talked about cybersecurity and the things that we need to implement to protect this country. So again, there has to be some sort of compromise. I don't see what type of framework you're going to have for $18 trillion in deposits. But again, I can see some fixes that we could put into place to shore things up. Common sense stuff to instill a little bit of confidence. All right, let's talk about the mortgage debt market. How exciting! Mortgage debt market. Okay, the mortgage debt market. Again, people, I know it's ringing back in your head. You're going back to The Big Short in 2008, 2009, and all of these mortgage-backed securities that were AAA rated, but were dog poop, because that's what they were. They had AAA ratings on them. Stuff with all sorts of garbage mortgages. Putting these things together was a big business for Wall Street, and selling them and trading them and everything that went along with that. The mortgage bonds that are widely held by banks right now, they're primarily backed by mortgage loans from Fannie and Freddie. These are not securities you're going to see defaults in, and the defaults are managed. Very different. Okay, and this is important than what the situation was back in 2008. However, like all bonds, when interest rates change, the price of the bond is going to change. So if you buy a bond at par, we'll say 100. Let's say 100, and let's say it's paying 2%. Okay, if interest rates go up, let's say they go up by 200 basis points. Okay, guess what? The value of the bond is going to drop based upon that. So this is some of the securities that are out there floating around in all of these banks that are underwater. That means if they had to sell them right now, you're selling at a loss. Some of the Wall Street Journal today. When benchmark interest rates rise, bonds were sold at times of lower rates lose value. Prices of such low coupon agency mortgage-backed securities started dropping about a year ago. This is when the Federal Reserve raised rates to fight inflation and indicated it might start selling mortgage-backed securities it owned. Some of the bonds lost 15% or more in a matter of months. Again, this is a bond portfolio, trading as low as 80 cents on the dollar. Money managers who must mark investments at market prices sold a lot of their low coupon mortgage-backed securities at a loss, but banks held. Again, this is important right now, okay? Hold to maturity. They classified these bonds that were on sale, okay, if you will. They were trading at a discount, underwater, whatever it may be. They were classifying them as hold to maturity, which is different than the assets that you classify as available for sale. Now, this backfired. It's backfired on Silicon Valley Bank. Withdrawals started coming in, and they had no choice but to sell those bonds that they had marked hold to maturity. This is what everybody is doing right now. This is what they're looking at. They're combing the books to see who's at risk with these types of securities. Now, again, the Fed is backstopped to some degree with certain securities that they will take on loan at par and give a loan. And again, this is another form of quantitative easing. Again, as I go over this, do you get the sense that we just seem to be putting Band-Aids on top of Band-Aids on top of Band-Aids in order to fix the problem? Well, I agree. And what is they talk about the root of all of the problems that we have right now has been artificially low interest rates for an extended period of time. And again, you can go back to every situation. I can go back, and I've written about this. I'll go back to 1996. I want to date myself and see how old I am. 1996 was when Alan Greenspan, again, he was charged the Fed at that point in time. They called him the maestro. Oh, my God, the reverence that they gave this guy. It was back in the day, a briefcase indicator on CNBC. What's Alan Greenspan going to do? Alan Greenspan gave his irrational exuberance speech in 1996. He was talking about what was happening in the markets. Now, what was happening in the markets, which was artificial, was leverage. Way too many people going out and purchasing stock on margin, 50% margin requirement. Margin leverage is it's like lighter fluid. Okay, it's like squirting lighter fluid on a fire. When things start to go in the wrong direction, they go in the wrong direction, but quick. Because oftentimes what happens is the people that bought securities on margin, they don't have the money to come up with when the price is going the wrong direction, forcing a automatic sale, fire sale, got to make margin requirements, and then it just cascades. And again, Greenspan could have raised, and what we were pushing for is, I was early part of my career. What the hell are you talking about, Markowski? What the hell do you know? You're just a kid. The Fed needed to raise margin requirements. It would have tamped everything down, kept everything from getting out of control. Again, ultra low rates, 2000, 2008, 2009. What took place at that point in time? Again, people getting loans that they shouldn't have had, money not being priced accordingly every single time. It's the same. Fed keeps making the same mistakes again and again and again and again and again. And we led the charge here on the program. You know, it's inflation. Inflation is transitory. Inflation is transitory. And I'm like, what do you mean? Inflation is transitory. I'm pulling my hair out here, you know, when I go back and I actually think about this. When I actually, inflation is transitory. Guys, watching the same thing that we were all watching at that point in time. You mean to tell me that keeping rates at these ridiculous levels? I mean, I don't get it. I really don't. You go back every single time the Federal Reserve has maintained an easy monetary policy too long, then raised rates abruptly. The consequences have been jarring. This is from Mike Levy today. This time is no different. Even when the economy managed to avoid recessions, it couldn't avoid bumps in the road. Stock market crash 1987, savings and loan crisis early 80s, bankruptcy of Orange County, California, 1994. Every episode is different, but every episode exposes the weak links. Again, the whole Fed regime, what they're doing, they have to get rid of forward guidance. And again, you don't have to be spot on. You don't have to be spot on. You don't have to be 110% right. You just need to be in the ballpark. And 0% effectively negative interest rates based upon inflation is never a good spot. Again, it's going to be conversation tomorrow in regards to the Fed. And are they going to raise a quarter basis point? At this point in time, I really do think a lot of it, quite frankly, is out of their control. In my opinion, like I said, should stand pat. If they raise a quarter, who cares? But I've said it again and again and again. This is important, okay? The Fed hasn't gotten out of control. Rates have just normalized. However, again, it's a massive shock to the system and how quickly it was done. And it didn't need to be that way. It could have been little by little and started a year and a half prior to when it did. But again, you get the politics of the day, all the government spending that they have to continue to finance. It's always a problem. I want to talk a little bit about regulations as well. I actually looked it up. I went back to the columns I wrote back in 2008, 2009. I was talking about the repeal of Glass-Steagall, and then we had Sarbanes-Oxley and all of the regulations. And I thought about all of the unbelievable IPOs and companies that came about during the 1980s, 1990s period prior to the repeal of Glass-Steagall. And I actually took a look at some of the major IPOs from 2000 until today. I'm going to be honest with you, people. Nothing. I mean, Tesla, there hasn't been that much that's really been, in my opinion, game changers. There's still companies from way back when. And again, just take a look at some of the largest deals that have been done. They've been outside the country, whether it be Enel in Italy, whether it be Aramco in Saudi Arabia, some of the Chinese deals as well. All of these regulations that are put into place, and in particular, you're talking about Dodd-Frank. What Dodd-Frank essentially did, Michael Falkender, Tyler Goodspeed had a piece about this today, is it made all of the banks the same. They're all doing the same thing. And the point that they're making in their column is that when they're all doing the same thing, if there's a problem, they all, in essence, have the same problem. And they said these banks need to be diversified in the way that they do things in order to get rid of this. It's the definition of systemic risk. I mean, if one gets hit by something, they're all getting hit by something. It's counterparty risk. And their proposal was to just make the banks hold on to more capital. And I agree with that. But again, I'm going to go back to what I've said in the past. We need to rethink regulations. We need to rethink regulations. What we need to do is, again, we need to simplify. These big banks have gotten overly complex. I do believe that broken up, there's going to be a greater valuation than there would be when they're together. And I like to see, I want to have a more dynamic Wall Street. I want to have more mid to small size investment banks out there looking for great deals, looking to compete against one another. We don't have that. You got all these, mid-size regional banks that are in the business of rubbing elbows with venture capitalists looking to ladder up deals to ridiculous levels. And again, it hasn't been good. We've had a litany of deals, but let's take a look at the profitability of many of these companies, which is null and void. Again, too much when it comes to rules. Thousands and thousands of pages of rules and regulations that are written not in black and white, but they're written in gray. Again, simplicity is key. And then when I go back to Glass-Steagall, what was that piece of legislation? 40 pages long? 40 pages long. And it worked. WatchDog on WallStreet.com. WatchDog on WallStreet.com. Have a great day.